Well, good afternoon and welcome to HIROC's weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I am Scott Tomlinson, and we are joined on the call by my partner and colleague, Paul Tepsich, the founder of HIROC, as we are also joined by our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are our first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need to do is visit our homepage and click on the Introduction to HIROC Private Client button. While you're at it, you may be interested in our voluntary code of conduct as well, something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. As we always do, let's start with a quick review of our themes for 2017. We think that our strategy of having a tactical perspective to investing is even more important in 2017 because of the even greater levels of uncertainty imposed by an onslaught of developing factors. Inflationary expectations had been rising, but recent data suggests inflation is stalling and even falling in some areas. While other central banks have been more cautious, the U.S. Federal Reserve raised rates by 0.25% on March the 15th and is expected to do so in its next meeting in June, and at least one or possibly two more times after that over the course of this year. Stock prices and valuations are at 14-plus year highs, and at the same time, U.S. economic growth has not kept pace with stock market advances, and while earnings are growing, they are not growing enough, we believe, to justify current prices. And the Trump agenda has run into some political hurdles. Brexit has been initiated. The French elections have rejected populism. And meanwhile, protectionist concerns continue to rise, especially in Canada. Throw in escalating tensions with North Korea, global cyber attacks, and Russian controversy, and we have quite a blend of political uncertainty. One of the reasons that we desire a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between U.S. stocks and bonds in the U.S. and also in Canada. Paul, anything of interest that you want to add as far as our correlations are concerned?
It's still moving more positively for us, so it's or negatively, which is better for our hedging purposes. You can see on both those charts in Canada and the U.S., the bottom blue and blue line shaded green area is moving a bit more positive. So again, that provides more hedge, traditional hedge to our other parts of our portfolio that might be more risky, like stocks and credit, corporate bonds, etc.
Excellent. And for those who may be interested, I've just finished and posted a blog that talks a little bit about the correlations and certainly why we do what we do here at HIROC, because when we began our advanced approach to portfolio management back in 2015, we added a third model to the standard buy and hold balanced portfolio of equity and fixed income, and in an effort to try and find a way to add value to client portfolios while at the same time reducing risk, which means that we're maximizing risk-adjusted returns. And we are patient, waiting for opportunities to buy assets when the timing makes sense. Well, each week we look at the benchmark indices performance to allow you to make comparisons to your own portfolio performance. We take the allocation to the benchmark All Country World Index ETF and blend it with the Canadian Bond Index ETF to get a weighted return for comparison purposes. You may note that while the one-year blended benchmark net of fees has returned about 10.75%, the two-year annualized return has only returned about 2.5%, which highlights the volatility that we've seen over the last couple of years. Now, our focus is on reducing volatility in our portfolios in order to avoid the big swings in return. As we look at a longer-term HIROC private client, the one-year total performance after fees is 10%. That's slightly behind the benchmark, but with about 25% in a money market fund, this portfolio is significantly less exposed to expensive risk assets like equities. But the longer-term 4.5-year performance is still well ahead of the benchmark, a sign that we have been successful in lowering short-term volatility, which enhances longer-term returns. At HIROC, we focus on the difference between the absolute returns and the risk-adjusted returns. The actual HIROC private client return per unit of risk taken on an apples-to-apples basis significantly outperforms the 60/40 comparative benchmark. Now, graphically, you can see that the absolute return for the HIROC private client is higher and the risk taken significantly lower. Again, this is the key to steady, less volatile portfolio swings which elevate returns over longer periods of time. And we remind everyone listening that historical returns are no guarantee of future returns, but at HIROC, as you probably all well know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy, and our forecasts for your net worth into the future are up to date and heading in the right direction. Paul, I think you might have your phone open and I can hear some paper shuffling. If you could just mute it, it'll be great. Thanks. Well, inflation is one of our key themes for 2017 as we try to assess the implications of easy central bank monetary policy on current global economic growth. Expectations of tax reform and infrastructure spending by the Trump administration increased the outlook for a scenario of increasing inflation in the U.S. But so far this year, we have not seen this following through. As all central banks have a mandate to maintain price stability, this year we are focusing on inflation data as a key to determine if and when interest rate policy may change. While total inflation data had been rising on a global scale earlier in the year, most recent data, with the exception of the UK, has shown it to be slowing. The Bank of Japan, Bank of England, and European Central Bank have kept rates steady and monetary policy unchanged. Speaking of the Bank of England and the UK, last week, despite rising inflation, the Bank of England held rates steady but suggested that there may be need to some tightening of policy in the future. Inflation has been rising in the UK following the weakness in the pound subsequent to the Brexit vote. Today's data showed total inflation at a level of 2.7%, well above the 2% target. However, consumer spending has been falling and wage gains have stalled. The uncertainty surrounding Brexit negotiations and the economic fallout over the next few years will likely keep the Bank of England cautious. In the U.S., while target inflation has slipped, strong employment data have the Fed on a tightening bias, and markets expect a 0.25% increase at their next meeting in June, as I mentioned before. The second quarter U.S. GDP is expected to make a big rebound with increased housing starts and better than expected industrial production data that was announced today. The second quarter GDP forecast has been increased from 3.6% to 4.1%. Now, it's early going in the second quarter, so we'll see how this number moves as we progress through the quarter. Expectations for U.S. rates are to go higher, and that is significantly greater than most other developed economies. However, a flatter bond yield curve over the last week reveals some concerns over the economic climate, and we know that bond markets lead other financial markets. Now, the U.S. dollar index against the basket of currencies has actually fallen back pretty close to the pre-Trump election levels. And that may also have some telling signals for us. We'll keep an eye on that. On the debt watch, global debt levels are growing at an approximate 5% per year, while the global economy is expected to grow at only about a rate of 3% per year. So if interest rates do rise, as they have been in the United States, this puts an increased pressure on servicing of that debt. Canadian household debt is at record levels. U.S. household debt has jumped back to higher levels than it was in 2008, and emerging market companies and countries have also been building debt. And each week we also talk about our views of value in equity markets, and you may have been reading the headlines that have been telling us that first quarter earnings are showing the best year-over-year increase since 2011. Well, however, if you look closely at the first quarter of 2016 starting point, it was a pretty poor quarter. So in fact, the actual earnings per share were for first quarter 2017 were lower than they were in the third quarter and the fourth quarter of 2016. So not exactly as significant an improvement as maybe the headlines are making it out to be. The 12-month forward-looking earnings per share, which incorporate all the good news currently built into share prices, does anticipate another 10% increase in earnings growth over that period. But the forward-looking price to earnings ratio is already at an expensive 17.5 times, while the 10-year average is at 14 times. And we all know in time prices do tend to revert back to their mean, which indicates that earnings will have to grow by a significant 20% more than the currently expected 10%, so 30% more, to bring the ratio back to its 10-year average. Either that or the S&P 500 needs to correct by close to 20%, or perhaps some combination of the two. Nonetheless, as we have been saying for some time, it is not anywhere close to justifying current S&P 500 prices. Another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. And even if second quarter GDP comes in at higher levels, stock prices are still in need of some correcting to get them back to more reasonable point. And it may just be the reason that money has been moving out of U.S. stocks recently. What we have been suggesting looks like it is beginning to happen. High equity prices equal high risk in owning that particular asset class. And as we have proven, you do not necessarily have to own a full weight of that asset class to achieve long-term reasonable risk-adjusted portfolio growth. So for the moment, we are continuing to avoid being fully invested in equity assets, especially U.S. stocks. Well, on the geopolitical front this week, in the U.S., the healthcare bill passed by Congress and is now in front of the Senate. The budget debate will resume in September, and we are awaiting details of tax reform and infrastructure spending. There have been some other distractions, as you may have noticed in the news today. Certainly it's been all over what I see. And as we discussed a few weeks ago, the Bank of Canada is concerned about trade protectionism, and the renegotiating of NAFTA could indeed be, as President Trump put it, massive. But at the moment, we are a little light on details. As I mentioned earlier, the Brexit negotiation uncertainty remains a very important piece of the UK economic puzzle, and growth in Europe has been, over the last quarter, very uneven. In China, amid some slowing of April economic growth as credit tightens and bond yields soar, stocks are also feeling the impact. So here at High Rock, with all the upheaval happening around us, we continue to monitor event risk, which we think is high, and price valuation, which we also think is high, and we will add or reduce holdings tactically in our models as opportunity presents itself. We will also maintain the disciplined approach to our strategies with skill, competence and continued deep levels of research, adding value and reducing risk so as to give us all the best possible risk-adjusted returns. Paul, anything to add this week?
Yeah, funny you should mention risk-adjusted returns. I apologize for typing in everybody's ears because that's actually what I was calculating in the Excel file. Couple small changes we made in the portfolio, most notably, one in fixed income. We added a corporate bond, a high-yield bond that's been really hard to find. So we were able to find some and add that to certainly those that did not own any. So I was pleased with that. And in the tactical model specifically, we added to one position, and then what we did was we were almost out of one oil and gas company stock. We fully liquidated out of that and added to another one. The one we bought actually pays us a dividend, and I've certainly met with the executive chairman twice, I believe, over the last 2.5 months or so. And I've done a bit of work on this. I think it's a good steady dividend payer and has been for about 25 years. But I am still, you mentioned NAFTA, Scott, but that certainly has annihilated our Canadian energy companies and vis-a-vis against U.S. Exploration and production companies, U.S. oil and gas companies. They're off roughly 10%. Some of ours, most of ours are off, 30, 40% on the stocks. And I think a lot of that is just related to NAFTA. But I am moving away from oil a little bit and just adding small amounts of natural gas producers. Anyway, that's about it for the for portfolio update.
Tremendous. Thanks for that. That's great. Okay, so that's all we have for this week, but I will open up to questions if anybody out there listening live has any questions at the moment. No live questions, but folks, if you are listening to this on the recorded version, please feel free to send us emails and give us feedback. Certainly questions or any ideas, anything you want us to talk about. We are more than happy to have direction from you, things that that you want us to address. In any event, we will be back next Tuesday. Thanks so much for being here today. Have a great long weekend, and until next Tuesday, this is Scott Thompson, and on behalf of my colleagues Paul and Bianca, we certainly want to wish you all a great week.